In forex trading, one thing separates smart traders from emotional ones: preparation. And when it comes to preparation, nothing matters more than understanding high-impact events and how they affect volatility. Because the truth is, markets don't move randomly. They move when something triggers them. Those triggers are high-impact economic events. High-impact events are major news releases or decisions that can instantly shift currency prices. Think of things like central bank interest rate decisions, inflation reports, GDP data, non-farm payrolls, or statements from the Federal Reserve or European Central Bank. These events act like shockwaves. They can create strong momentum in minutes, break key technical levels, or completely reverse trends. That's why experienced traders always check the economic calendar to see what's coming next. Now here's the key. Not all volatility is bad. In fact, volatility is opportunity, if you know how to forecast it. Volatility forecasting means anticipating when the market is likely to move sharply, so you can plan your trades accordingly. For example, if you know the US is releasing CPI data in 1 hour, you can expect increased volatility in USD pairs like EUR USD or GBP USD. This gives you a choice: either step aside and protect your capital, or position yourself strategically before or after the move. But predicting volatility isn't a tea about guessing the outcome of the news. It is about understanding expectations. The market doesn't just react to the data itself. It reacts to the difference between what was expected and what actually happened. If inflation comes out much higher than forecast, traders may expect rate hikes, which usually strengthens that currency. If the data disappoints, the opposite happens. The bigger the surprise, the higher the volatility. Many traders make the mistake of entering trades right before these events, hoping to catch the move. That's risky. During high-impact news, spreads widen, slippage increases, and prices can move so fast that your stop loss doesn't trigger where you expect. Instead, the smart approach is to use volatility forecasting to prepare, not to gamble. You can plan to trade after the event once the direction becomes clearer, or use pending orders strategically around key levels. Either way, the goal is control, not luck. Also, remember that volatility isn't constant. It follows patterns. Mondays and Fridays often bring less predictable moves, while midweek tends to have more data releases. Similarly, sessions overlap, like London and New York, usually create stronger price swings. By combining the timing of high-impact events with session behavior, you can forecast when volatility is most likely to spike and adjust your risk accordingly. At the end of the day, successful forex trading isn't about avoiding volatility, it's about understanding it. When you know what's driving market movement and when it's likely to happen, you stop reacting emotionally and start acting strategically. So before placing your next trade, ask yourself, what's on the calendar? What's the market expecting? And how could that impact my pair? Those simple questions can protect your capital and turn volatility into opportunity.